Thanks everyone, thanks for joining. Very happy to organize our fourth panel of the Singapore FinTech Festival Lab Pro. We're very excited to do this in person. We unfortunately couldn't do this for the past 2 years, and just meeting people in person makes a whole difference. So thanks for doing that. It's an opportunity for us at SC Ventures to promote our ventures, but also the ecosystem partners that enable us to bring these ventures together. We talk about SME, world trade, financial inclusion. We talk about digital assets and a number of other topics. But really what it is how we build ventures that have innovative, resilient, and sustainable business models in Singapore, but on a global market landscape as well. On this session, we're going to talk about global trade and how fintechs and banks can team up to promote global trade, and especially in this current context. To speak about this topic, I have three panel speakers with me, which I would like to welcome and thank. So I'll start with our lady on the panel, Amelia Ang. Amelia, you're the former head of strategy for Standard Chartered Bank, and you decided to actually launch your own venture, I would say about a year and a half ago, something like that. So Olea is a trade finance fintech, which is a JV between Standard Chartered Bank and Link Logis. Amelia, thanks for joining and welcome on this panel.
Thank you.
We also have Seo Young Lee. Seo Young Lee, you recently came back to Singapore. You're one of the partners at Wyman. You're also the head of institutional banking and corporates for the region. Thanks for joining us on this panel and welcome.
Thanks for having me.
And we also have Atul Jain. Atul, you're global head of trade finance and lending for Deutsche Bank. And thank you for joining us for this panel.
Yeah, thanks.
I'll start with maybe the context. So a complicated context of global trade. For the past 5 to 10 years, we actually have seen deglobalization. We've seen power plays like the US, China, impose tariffs on each other. That obviously has an impact on the free flow of capital, trade, and people. To top that, we just came out of COVID-19 restrictions, which are not actually lifted in every part of the world, which has complicated the global trade as well. And recently, to top it all, we have the recent war in Ukraine. So what's going on? And I guess how does it impact your business? And what are some of the challenges you are facing, but also some of the opportunities? How about, we start with CEO, since you manage big corporates. Does this have an impact on your business?
Absolutely, and looking forward, when we think about the global trade, there are a number of concerns that a lot of people are expressing. So maybe I can talk about just 3 broad categories. Some more opportunistic than real, but just starting with the overall macro conditions. We are seeing weakening of demand from the US, and it was really the US that was a power engine over the past couple of years driving the rebound from the COVID crisis, which was really a trade-led rebound than a capex-led rebound. But we are seeing weakening of demand from the US, and that is actually loosening up some of the conditions that we have seen in the global trade as well. But that's one concern from my perspective. Europe continues to struggle. Asia is quite interesting. So Asia was supposed to be a bright spot going into next year. But if we look at things like manufacturers PMI and some indicators, the indicators for the larger economies such as Japan, Korea, and even Singapore, so economies that tend to have large tech sectors, as an example, the indicators are facing coming downwards. And we feel even in Asia, we are going to have some divergence between the economies that are more export-driven, technology-driven, will fare the situation a little worse than the other. A lot of economies in South Asia, they are more domestic demand-driven. So there's the global economy situation that will have an impact on global trade. We also see some concerns around supply chains. So on the surface, supply chains seem to be normalizing, and things are looking a lot better, and delivery times are decreasing. A lot of pressure is being taken off the very difficult situations that we've seen over the past year or so. And if we look a little deeper, it's not because the supply chains have become stronger or we've built in greater resilience in supply chains. It's because the demand is weakening in the US, and as things are somewhat coming out of the lockdown situations that we've had during the COVID times. But if we were to look a little further, and if we were to take the energy situation into context as well, what could happen as the war in Ukraine continues on, and as or if the Chinese economy opens up and starts moving along again, which will consume a lot more energy, that could potentially lead to higher energy prices and increasing of freight and transportation costs again, jam up the capacity that we need in global trade, and put us back into some of the difficult situations that we've seen over the past couple of years. There's a lot of pressure on the labor side of the equation as well. The labor still feels overstretched. The inflationary pressure that we're seeing is baking in additional unhappiness with the labor force. So would we see a smooth kind of labor market next year with gradually increasing productivity, or will we face some large-scale disruptions, maybe some large-scale strikes, or some of the situational effects that will hamper smooth functioning of the supply chains? And once again, if we look at the supply chains over the past couple of decades, the global supply chains and the players around the supply chains have invested quite a bit in making the supply chain as efficient as possible by baking in complexity and making the supply chain even less opaque than before. There's not a lot of resilience built into it. So as we come out of the current situation, but with a bunch of these uncertainties, we feel the supply chain could be another pressure points next year, depending on what happens with China and so forth. The last bit is on the climate transitions and carbon emission goals. So we see it really depends on government policies across many geographies. But if there's mismatch in reconfiguring supply chains to move away from suppliers that cannot cater to the carbon emission goals, and the pace at which there will be infrastructure to bring in those suppliers, then that could also lead to the slowdown in trade and global economy. So there are multiple watch points as we think forward into the next couple of years when it comes to global trade.
Amelia, maybe your point of view as you just launched your venture to address global trade finance. So maybe some of the challenges that you did not expect, and how adapting to them has opened up new possibilities for you.
Well, I first of all wanted to echo what Theo was talking about. We do see quite a lot of supply chain disruption. A lot of corporates are responding to it. The way they respond is, number one, that we do see a migration of supply chains. I mean, a lot of them, like Theo talk about, they focus they focus on the resilience, which could be, we see a whole range of different response, right? Some of them are saying, okay, I keep lesser number of suppliers, but then I want everyone to be closer to me. There are also responses that say, I'm changing my payment terms, I'm keeping my inventory level higher. So these are the various responses we have seen from the market. But at the same time, one other sort of scenario that happened right now on the macroeconomic is there's quite a lot of analysts are coming out and saying that we have lived in a world of quantitative easing for the last 20, 30 years, whichever way you want to count it. Right now is in a major structural changes. So a lot of people are expecting this is structural. And we do see that there are quite a lot of people because of the increase in interest rate are coming into play, particularly the private credit funds. They actually see the opportunity. They think that trade finance as an asset class is undervalued. And therefore, I actually think that it's a balancing act. There's a lot of challenges, but at the same time, there are, I would say, silver linings, but that mostly require ecosystem partners and everyone at banks or fintech to respond fairly quickly to actually tackle the issues.
We'll come back to that, but before we do that, maybe Atul, the perspective from a big bank. So how are big banks reacting to the disruption of supply chain, the repatriation of certain suppliers back in original countries and so forth? How do you guys tackle these challenges?
I think, we exist for our clients, right? So we have to kind of follow their behavior, and I think Sale had outlined a few of the trends they're facing. I would agree 100% with that, but I would still say there's reasons to be positive, right? I mean, we see that in the context of even the iPhone 14, how much of that production has already moved to India. We see, companies adopting differentiated strategies. So when it's in the context of China, more local for local. In the context of the US, either nearshoring or friendshoring, if you want to call it that, for semiconductors. So I think supply chains are more resilient than we expected, but it comes at a cost, which I think was Amelia's point. And that is putting stress on corporates and certainly on margins. For a trade finance provider such as ourselves, we actually welcome that need for clients to seek advice. Ultimately, as a bank, we're providing service, we're providing solutions. And in an environment that was relatively benign, to Amelia's point, for maybe 3 decades, we're largely a flow provider, much like practically anybody else. This has now created an environment where we can be more differentiated, more innovative, and more value-adding.
And so, in the context of as you said, the disruption of the supply chain. So when everything goes well, basically, you don't really question the way you do business, but now you have to be more innovative. Maybe just how you work with the ecosystem partners, and especially fintechs, and how does that enable you to maybe tackle some of these macroeconomic conditions of raising inflation, of supply chain disruption?
So, I'll extract myself as an employee of Deutsche Bank in making this comment, because I'll speak kind of as an industry more broadly. I think as an industry, we're just atrocious, right, at kind of working with partners. Still, because it's very much us versus them, right? There is no concept of there's a common problem to solve and let's kind of work together to figure out how to solve it. To be fair, and now I can say this sitting in my seat, there are also a lot of little providers trying to solve very little parts of the problem statement. Ultimately, no institution has the patience, resources, investment dollars to kind of stitch something together, that kind of solves for everything. So, one of the things that has become quite clear to me is any solution we adopt has to be at scale. Otherwise, it's not a solution. And so as soon as you start to kind of unpick that and look at who's out there and what problems they're solving, and then again, how can you translate that from one country to one region to a globe? And ultimately, that's what trade has to kind of service for. It gets very hard. Now, again, that doesn't mean we can't do it. It just means that today it's presented more challenges than not. I think one of the differences, coming back to something Sale said, is, trade has by definition been cross-border for a long time. And that was also in the context of a lot of the growth being export-driven. As it shifts to being more CapEx-driven, domestic trade will also increase significantly. Domestic investment will also increase significantly. And the role of governments in either directly providing the finance or incenting others to provide the finance will also become much more visible. And that also changes as banks how we need to engage with nations and how we need to look at solutions that are, again, perhaps corporate involved, but not necessarily corporate led. And that is a very kind of big change in strategy, or at least an approach to how we've prosecuted business as an industry for, again, probably 4 decades. I can definitely unpick a little bit why the fintech bank collaboration hasn't worked so well to do, but maybe I just let others kind of comment on
How
that.
about you give me your perspective, and then we'll pass it over to Amelia too.
Okay. So I think the first thing is scale, as I said. Ultimately, we need to have a solution that we think can work across borders, where you can share information with counterparts, where you can share information with regulators, where you have one version of the truth, and that is technically possible. There's no technological gap to that, but especially in the context of what's happened in the last 2 years, there's not only kind of increased risk as you digitize everything, especially if you just digitize the status quo process, but there's also increasing state risk. Yeah, in the past, no one would think about giving information to the government and that potentially being used in a way you didn't want it to be used. As you said in the introduction, geopolitical tensions are changing that narrative, and so you have to be a lot more careful around that. And then you think about, where do you have players who are non-nationalistic aligned, who are independent, who are, whether it's for-profit or not-profit. I mean, outside of SWIFT, I can't really think of many that truly would be considered global solutions to the problem. So that's one challenge. The second challenge is, in an environment where you have heightened fraud, especially in trade, where you have heightened credit risk, what you by definition have is a higher capital requirement. And it's very hard to think about investing, for 3 years, 5 years, 10 years in an environment where for the next quarter or the next 6 months, you're trying to figure out how to optimize the return on that capital and protect, shareholder money. And I think that goes back to a really important point when it comes to banks, which is I don't think many banks at the moment have really a mandate from their shareholders to operate with kind of a 5-year, 10-year lens, simply because that's not how the industry has been built to date. And that certainly then creates a bit of a misalignment in objectives, incentives, whatever you want to call it, between fintechs and traditional financial institutions.
Amelia, your perspective on that?
I definitely think there are quite a lot of rooms for improvement. It itself sounds like a motherhood statement because there's always rooms for improvement. But I do think that the dimension in terms of the I would say the binding constraint of regulated entities and versus the fintechs are quite different. And sometimes they focus on the use of capital and also the sources of capitals are different. Therefore, it can create actually rooms for both sides to work together. But I definitely actually echo with what Atul said, right? For a bank or even for a fintech to look for a long-term partner, it itself requires a lot of work. A lot of work on multiple levels, a lot of work on getting to know each other, aligning your interests, making sure each other's process, legal, and also the way that you see opportunities are all aligned. It is not a small effort. If things can't actually, if both sides don't see a big opportunities together, it is really time consuming to talk about even cooperations. Because in the last sort of 10, 20 years, I am sure you guys are, or in the last 24 months, you guys have been keeping, LinkedIn become a social media for professionals, right? You've seen a lot of people coming out to say, oh yeah, I have signed cooperation. I'm so happy to actually work with so-and-so. But in reality, a lot of these are just talking points. There's little actually landing. So I for me, for most part, if I work with any long-term partner like banks, I would rather prefer to have 1 or 2 focus area, and you make it work before you actually jump. And I have a little bit of measure approach is I don't like to have a partnership with more 3-4 people or 3-4 counterparties than because if you think about it, you're making 2 people align, see eye to eye is an effort. I find that 3-4 and then as the number increases, the difficulties actually increases. So for me, is really picking the right partners and starting to really get to know each other and then actually work together. I see a lot of rooms. The industry has moved a little bit, but in terms of like in the past when I was in the bank, it's this bank versus our bank, your bank versus my bank. So it's quite a lot of this. Inevitable. But again, the world is moving towards an era or a place whereby you do need people when we do see limitations on each of the players. So I'm hopeful.
So I wanted to go back to what you were saying because obviously in time of challenges also comes how we face these challenges. And I think you mentioned, for example, opacity as being one of the issues. What are some of the trends that you see that are evolving to enable a betterment of global trade?
Yes. So before I get into that, I really appreciate what I'm hearing from Atul and Amelia sitting in the middle, saying how important it is for big banks and fintechs to work together, but how complex it is. I'm just thinking there's a lot of work for us to do. Sitting in the middle.
From a consulting firm.
but related to that, I think there are. I'm essentially echoing the great comments that Atul and Amelia made on what the challenges are and where the solutions might be. But these are really big, complex problems that are cross-border in nature, that are that are structural to the overall industry, that not a single bank or a single fintech can tackle. All the participants of the system need to come together and address these together. But some of the areas that are being looked into, that are being considered really important, are things like credit decisioning, that Atul touched upon it, and he went a little further into things like how important it is to understand fraud risks in trade, which is a really important topic. And if we look at the trade finance landscape, there's still a very large degree of trade finance rejection for SMEs, because it's that much difficult to assess the credit risks of SMEs that are in different jurisdictions. Think through fraud risks, to KYC and onboarding and so forth. And even after we onboard them, there's a lot of friction in the process as well. So how can the banks and fintechs come together, apply more of data and advanced analytics, so with alternative data as well, to improve the overall credit decisioning process, so that we can embrace a bigger part of the whole trade system and decrease the rejection rates on trade finance. I think it's one of the key areas where we are seeing some solutions emerge, and it's going to be one of the key topics that banks tackle along with fintechs. Another topic would be back to supply chain that we are talking about. Supply chain today is very opaque, and that leads to, and we've seen this especially in the past couple of years, that leads to a lot of vulnerabilities and a lot of cautiousness on what kind of supply chain that people want to build. So how do we bring greater transparency and traceability to supply chains so that they can react to it through technologies that will enable them to understand where things are, flag any potential risks, and even mitigate. And as we are able to bring more transparency to supply chain and inventory levels across supply chain, they can also use as data to support the credit decisioning and compress the time, the mismatch between the physical supply chain and financial supply chain, which will improve things greatly. The climate is another key area. I mean, a lot of the big corporates, pretty much everybody is looking into how do we reconfigure the supply chain, because they have obligations to report their
net zero objectives.
But there's just not enough data infrastructure for them to stay on top of how much carbon emission there is in the supply chain. And that's definitely not something one bank can tackle or one fintech can provide in terms of solutions. That needs a much more broad-based response, so that everybody can be on this journey together without over-investing in trying to go after same data. And there has to be certain standards around this as well. There's one additional topic that I mentioned that I want to pick up from what Amelia mentioned in terms of the importance of capital. So with regulatory changes on capital, with Basel III being implemented, banks are under a lot of pressure on trade finance assets. The RWA weight on trade finance assets is enormous compared to the previous regimes. And it's not just trade finance with capital output floor. The overall corporate banking franchise is under somewhat of a threat from how much capital do we need to support the franchise for our clients. And what it's the direction is pointing to is maybe that under this particular regime, banks might not be the natural balance sheet holders of these risks. And how can the financial system work with fintechs in the broader financial community to match the risks to the natural holders of those risks is another big question that this industry is grappling with. And some really good solutions are coming out into the market as well.
Yeah, maybe just on the topic of data, I wanted to hear a little bit back from Amelia on the solution that you are developing. How important is the data in your solution, and especially for your partners, whether you're banking or investment partners, and what type of data are you collecting and all of the information flow that you're collecting?
Well, I think if my answer is data is not important, then everybody will not really believe me anyway. I think data is, I think not only fintech, I think for consulting firm and banks are actually a critical element. It's not even like future tense, is actually present tense. So I think in the last few years, I would say a lot of technology that trade finance really require is actually quite mature. The question is about applications. So at Olea, we actually already do majority of our KYC. It's a data-enabled process, which means that we are able to connect to various data sources across markets to get the genuine sort of sources of the data to validate what's coming in from our clients. And obviously, like we all agree, right? Trade finance is full of fraud risk and full of counterparty risk, not to say less. So I think data helps a lot. And more importantly, I think right now, a lot of companies still talking about pillar 1 and 2, right? Trade finance, in fact, has the power in providing the industry information and insight into pillar 3, which is not a lot of companies are doing. I mean, we definitely haven't cracked it. We hope to work with people that actually crack this issue together. But by the very fact that we in fact are connecting with the buyer and the suppliers, we will have our data sources. And for us, the data and also the AI technologies that come with the predictive analysis that we can apply for the data is increasingly valuable. We have the benefit of some of the historical data from both sides, from our parents, but obviously mass information. But it helps a lot in advancing our models, both in terms of credit risk model and also performance risk model of transactions. And we are working on the fraud risk as well. It is not an easy solutions, and any fintech that set up for a few years to tell you they crack it, I think everybody knows, model require history and data. So I think, again, it's something that we are working hard on. And I believe one day the industry will have a better way of sharing information without actually violating the data privacy issues and be able to actually help the entire market to move forward. I don't know yet. This is something that we're working on.
Maybe just going back on the technology and a question for you, Atul, which is you mentioned when you look at partners, you look at partners that can scale with you. You mentioned the SWIFT network. Obviously, in the past few years, there was the rise of distribution ledger technology, blockchain, and so forth. Are these also technologies that banks are starting to adopt? What are some of the risks that they see in adopting blockchain technologies and some of the benefits?
So I think a lot of the investment that we've made so far in technology has been around data, right? Because we need to make sense of all the information we're storing without having the ability to take unstructured data and put it into structured formats. It's useless, but I think is kind of a blunt way of saying what I was alluding to. And so we've done that in the context of fraud detection, process improvement, de-risking, sustainability scoring. Blockchain to me is not in any way necessary to deliver on the promise that we have as an industry. The challenge that we have still becomes, and I think Sale was kind of alluding to that point, any trade finance transaction, and I think the ICC had looked at this 2 or 3 years back, has 15 plus unique counterparts. Unless everybody's on the same network, there's no point in a bank or a fintech provider or a client kind of adopting the solution, which is why sometimes I get rather annoyed with these press releases, because there are a lot of people working on proof of concepts, but there was a term I heard a few weeks back, which I liked a lot, which is proof of value. And I haven't actually seen that with a lot of the DLT technology that's out there. That's where I keep coming back to scale, because again, the data, if you can make sense of it at an institutional level, is powerful. If you can make sense of it at an industry level, that's when things like fraud detection really kind of tease themselves out, because a lot of it can still be in the context of financing fraudulent documents, collateral fraud, duplicate financing, which is the one thing that even if an individual and a fintech work together, you can't stem out. And this has cost the industry, more than 10 billion just in the past 2 years, in the context of COVID. So I have nothing against DLT as a technology, but as kind of a panacea for solving all the problems of trade finance, I haven't seen it.
I think it goes back to what you were saying, moving from POC to actually demonstrating value and solving for the problems, right? And we do see, unfortunately, a lot of use cases which are driven by the wrong reasons instead of solving the problems that are at stake. On maybe just going back to one aspect that all of you mentioned, which is sustainability. So how important now is sustainability in global trade? Is it a true objective? Is it greenwashing? What are the true intents behind sustainability?
Okay, so maybe I'll just be quick and then pass it on. So again, as I said at the very beginning, we exist for our clients. It is important for some of our clients, but not all of our clients. And I have to admit, I draw a pretty clear delineation between developed markets and emerging markets. The more time I've spent with clients in Southeast Asia, Sub-Saharan Africa, et cetera, LATAM, their feedback is our primary objective right now is to keep our people employed, to allow them to put food on the table. Whether they drive EVs or not, we don't really care, right? And so a lot of the frameworks right now in sustainability are largely developed markets frameworks, solving developed markets problems. Our clients tend to be more developed markets biased, so that's okay. But I do think that's why, to your point on greenwashing, there will be an element of that no matter what, because it's just a term that I think effectively is trying to say there is not a way to go from 0 to 100 in one step. There is going to be a period of what I call transition financing. And as long as you can demonstrate that that transition financing is viable, that the plan is robust and not just, again, a press release, then I think there's nothing wrong with supporting our clients in going through that journey. But it's going to be multi-step, and as I say, in our case, we're also trying to differentiate a little bit between, again, the needs of developed markets and emerging markets, because I think in one, the E becomes more important, and in the other, the S becomes more important. And I think right now, when we talk ESG, there is still overwhelmingly a focus on the E.
Yeah, on environment. But maybe just and we'll pass it to Cyril right after. But would you encourage sustainability practice, and ultimately, will you see better rates, better lending conditions, better financing conditions if they comply with certain ways of doing business that are more environmental friendly? And going back to the collection of data, will you ever look at this? I'm sure you will. But will you incorporate it into your data information?
So, we already are, and we have been for more than 3 years. And I think on that, we're pretty far ahead. In terms of whether we use it then to, kind of incent or disincent behaviors, again, we're already doing that. Even in the context of supply chain financing, we have data on suppliers, those who comply with more sustainable practices, we'll see differentiated pricing to those who don't. But as I said, that's taking some very specific and extractable data points to make those inferences, not necessarily, kind of the solution that kind of, we look for in kind of 10 to 20 years. Part of the reason I hesitate a little bit to say yes, even though it's so obvious, is because of everything I think Seo had mentioned at the beginning, which is there's so much change that we have to work through, so much change that we need to finance, so much change that we need to manage in our organization, that it's important, but it's not the most important thing we're doing, right? And as long as it's not the most important things for our clients, it won't be for us. And again, overwhelmingly, I haven't seen it be priority number one for most of them. Right now, it's really about survival, managing supply chain disruption, protecting their operating margins, keeping their people employed. And yeah, ultimately, those are hard questions. And we need to kind of make sure that those get solved before we then, kind of make ESG the overwhelming priority. But it is important, because obviously if we also put it at the bottom of the list, nothing will get done, and we're out of time. So that's where it does feature. For banks, I think we're making it important to our clients, but it's going to be one of a package of things that we look to solution around, not the thing.
Yeah, solving for immediate problems while still having the long-term vision. Yes. CEO, what about on your practice? How important is sustainability? And maybe not just sustainability, as Atul said, ESG, do you see a focus on environmental versus other aspects of ESG as well?
Sure, absolutely. So from directional perspective, all of ESG phenomenally important, and then there's a very strong rhetoric that comes out every day. But I couldn't agree more with what Atul said about the pace of change and speed at which we pursue sustainability and ESG. And the rhetorics that we hear from different geographies, even today, are quite different. They keep changing. There's one thing that comes out of US with kind of a little more urgency than before. Europe's looking at very cold winter, and with LNG prices going through the roof. I would be surprised if we hear less of this in December and January than even now, because things are pretty dire right now from overall energy perspective. And if we look at Asia, there are different speeds here as well. Japan is very keen on moving forward, although they still are trying to come up with some solutions and what the next wave of energy source is going to be for the economy. And then if we look at other parts of Asia, such as Southeast Asia, the economies will need to go through a certain level of sophistication. The infrastructure will need to be built as they transition towards more sustainability. So thinking through these complex dynamics across geographies, in our view, is very important. But along with that, but if we were to look at the larger end of the spectrum, MNCs, for instance, they do have their supply chains around the globe, and they do answer to the jurisdictions and regulators that are much keener about moving faster and more adamant in the sustainability space. So they are under a lot of pressure to revisit their supply chain configurations and understand what kind of greenhouse gas emissions the supply chain is producing, so that they are able to meet with their stakeholder expectations across shareholders, customers, and the regulators. And that is happening as we speak. And that's also why it is so important that that these companies are able to acquire the right data that is needed, and then dynamically model as they continue to reconfigure the supply chain. And there, in our view, that journey is super complex. So if you were to think about cars, for example, there's huge excitement about EVs everywhere, and nobody wants to talk about how exciting it is to drive an internal combustion engine car. Unwinding the supply chain takes some time. Building the whole infrastructure for EV takes a lot more time to happen at scale. And can that really happen all together at once? Or will there be greater rhetoric to move away from internal combustion engines before all these markets are able to embrace the EVs? And if that mismatch happens, how much pressure will the industry need to bear in terms of not being able to meet the sustainability targets and additional pressure that will come into supply chains? So I think these are really complex questions. The greenwashing that you mentioned, I think, is a really important one, and there's just not enough data anywhere to protect companies 100% from being on top of exactly what kind of emissions they're seeing. So that is an area that will require overinvestment, and something that not one bank or one fintech can do. There will need to be industry-wide solutions.
And especially for scope 3 emissions, right?
Which
is the one,
exactly.
So the one they don't control, basically.
Yes,
right?
yes, absolutely.
And maybe over to you, Amelia, on sustainability and whether or not it's something you
I
incorporate.
definitely see the world is actually different standards. I have we have one MNC clients that actually telling us that they source extensively from Asia, and knowing the energy sources across Asian countries are less than what they desired. So they actually go out and source solar panel for all the suppliers in Asia. And the question is do they have the money? So there's a whole range of different requirements. There are definitely a developed market standards versus a developing market standards. And when I talk to the typical funders of trade finance, it also varies. A lot of them will say, yeah, if you can actually source any sustainable asset to us, that would be great. But then if you ask the honest question is there any price difference? I haven't seen that. Will there? I hope one day it will, so that you align the interests a bit more. At the moment, it's everywhere. People talk about it, it's definitely an important agenda. I don't see a material step to sort of behind and drive some common standard and practice. My view is if you not having a common standard is very difficult. Like you said, right? You said greenwashing. I kind of like, yeah, apart from the exceptional cases, many of them are not really intended to do that, right? It is a consequence of not sufficient standard, not sufficient data. Like, it's just hard.
Thank you. We're going to ask questions to the audience. I'll start with you.
Hi. So firstly, thanks for all your great insight. There's a lot to take there. My name's Julio Romo. I work for, well, my firm's 247 Strategy, but I'm working in the regulatory space. One of my clients, my main client at the moment is the UK government, the Department for International Trade. Fintech for trade kind of is expensive, obviously. But one of the things that for me that stood out is obviously a lot of the talk is very much for enterprise at the moment. Well, trade obviously is very much about the SME. And I wanted to see if you have, or if you've looked into that perception of SMEs looking at fintechs, specifically for all the various de-risking, securing payments as well. And there is a perception issue then perhaps. How do you get those businesses to consider fintech to enable them to not just increase trading, but for many in different markets around the world, start trading internationally as well?
Well, for one, we have Solve, SC Ventures, which enables SMEs to digitize completely their operations. But I do think SMEs are a full participant in that ecosystem and to enable trade and doing better business. But maybe on your side,
Maybe I'll tell you the personal experience. We do have SME coming, but obviously, like we all discuss here, right? Trade is one thing you don't want to do is actually don't want to face or you don't want to deal with is fraud risk. So for us to actually, for Olea to deal with SME, we actually start quite a lot of times from the buyer side. But of course, then you argue that if you started with the buyer side, the SME is already quite qualified, right? And we do start with that first, and many of them is maybe the first or the first year or the first few months they actually trade internationally, and they just got a new contract, and the local banks actually don't have US dollar liquidity in this part of the market, and that's why Olea choose to actually have base in Singapore. Partly because, well, not only is manufacturing hub of the world, there's also quite a lot of markets. US dollar liquidity, which is 70-80% of the merchandise goods trade, is actually domiciled, is indeed sort of US dollar. So it is actually from that angle we are actually helping, and to be honest, I don't think that would require a lot of convincing, so long as you meet their requirements, which is the US dollar liquidity at a certain rate, and I think a lot of them understand it. It's actually require, but the selections of which SME we actually would like to work with is a very difficult topic. We don't work with the range.
MSMEs.
Yeah, I mean, no, the MSME don't trade globally. So by that definition, it's not our target market. SME is starting to be interesting to us. And SME that actually sell internationally is squarely SME mid-corp. I mean, there's a blurred line depending on countries and depending on your segmentation. You might be talking about the same group of clients.
I think we have time for one more question because we went over time. So I don't know if anyone has any further question.
focus on originate to distribute in the banks. Be it asset-backed securitization or funded or unfunded risk participation, right? And there are a lot of fund houses, FIs with adequate capital ready to purchase these assets. So how has been the progress in this particular space in terms of collaboration between banks and banks?
I could start and then I think we should hear from other panelists as well. So I think the progress is real, and there are tailwinds from multiple places. From the bank perspective, the new regulatory regime, the capital regime, is putting real pressure on the RWA concerns for trade finance assets and other assets as well. So from bank perspective, banks are looking for solutions. From the capital markets perspective, there is a very strong shift of capital from public capital to private capital. In the private capital space, there is now even a lot more interest in building up the private credit, private debt space compared to other asset classes. And that seems to be where a lot of the capital is being about to be deployed. And then of course there is a technology layer that's popping up, and fintechs are facilitating these trades. So progress is being made. And in the private credit space, if we were to look at a broad spectrum of types of credit, from those that are a little more bespoke, we can start from things like special situations that are very bespoke and not easy to be dissected and distributed. And then there are credits that are much more standardized and can a lot of value through additional degrees of standardization. And things like trade finance assets, in our view, fit right into that category. And there are, and that is, in our view, exactly why the fund houses that you mentioned are popping up, coming out to places like Asia and raising capital, because there's a lot of value to be unleashed from that activity. And from the investment perspective, there are insurers and pension funds that are always in need of these high quality standardized credit that where they might be more natural holders of those types of credit compared to them sitting in bank balance sheets, where it's becoming increasingly more expensive to warehouse those assets.
Atul, did you want to close on this topic?
Yeah, sure. I'll keep short. I mean, I think that it depends how you're framing your question, right? If you think about it in the context of our banks optimizing the return on tangible equity, yes, right? Because of everything we discussed before. Operational risk, credit risk are up, RWAs are up, and so there's pressure to kind of unload that off the system. But I think if I connect that to the prior question, the challenge is banks aren't using that freed up capital to put back into the real economy, right? No one's using that to kind of loosen credit standards or kind of be innovative around the way they use data and provide capital into the hands of those who need it in a cheaper, faster format. That's why the ADB loves that number they put out every year of the trade finance gap, which just keeps going up and up and up and up, and I think it's now around 2 trillion. So and it was 1.5 trillion.
It was 1.6 not so long
ago. Yeah, exactly. So it's definitely, again, been a tool for banks to use to create efficiency, but not necessarily, again, to do something with that efficiency other than really P&L optimization. And that's where, again, for a provider like Olea can hopefully come help bridge the gap, but that's also going to take investors to really understand this asset class, which I haven't really seen too many of today.
Well, thank you very much. Thanks everyone for coming, and if you want to continue networking, we can do it outside the room. Thanks for coming.